Hi guys, welcome to my channel. We want to discuss stock market, everything you need to know about the stock market, and most importantly, how you can make money from the stock market. I'm starting with a conclusion instead of an introduction because it will be a long video. So I really want to tell you what's involved so that it will be worth your time. It will turn you from a beginner in investing to an expert. There's no jargon. I am breaking the stock market bit by bit. That's why it's long. I am exposing and explaining everything that's involved in the stock market, not just explaining it, but I'll be giving you real life examples of whatever I'm talking about. All those concepts you've been hearing have been throwing at you up and down about the stock market. The stock market is up, there's stock crash, there's this, there's that. All of them are explained in this video in a digestible language. I make sure that you understand what is actually happening. I want to take you from a beginner level to an expert level. So that involves taking it atom by atom. I'll also be doing a live demonstration where I will invest $100 in this video for you to see how it's actually done. Finally, if you watch this video, you will know about the past of investing, the present, what's happening in the current state, and what is even more important is you will know the future of investing. So it's a complete ultimate guide to make you a pro in investing. Now, introduction. Who am I? I will tell you about myself, who I am, and why you should listen to me. Secondly, I will tell you about the basis of the stock market, what's involved in the stock market, the whole noise, the whole news. What is it all about? Then we'll talk about the type of investing, telling you the different ways that you can invest your money and make more money. Not only will I tell you, but I also show you how to invest. And even what's more important is I will show you the risk versus return ratio, how you can mitigate risk so that you increase your return while decreasing your risk. And finally, as I told you earlier, there will be a live demonstration where I will invest $100 in this video as a real life example of investing. As an introduction, my name is Daniel. I did my master's at Imperial College London. I did my master's at Imperial College London in petroleum engineering. Some people will be like, wow, you did engineering and you're talking about finance on YouTube. I guess it's no longer new that a lot of engineers move into the financial corporate world. A good number of bank managers are actually engineers. Let's assume that I'm one of them, or I'll be like one of them. I've worked in share, oil and gas engineer. I've also worked in finance, in AXA Insurance. AXA is one of the most popular insurance company. I think they sponsor Liverpool. As of now, I work in an investment bank as an analyst. And if you are interested to see my day-to-day life, I've made a video where I showed you a typical day in my life as an analyst in an investment bank. On the side, what we call side income, side hustle, I make YouTube videos like the one that you're watching. On YouTube, I talk about how to make money online, the several different ways of making money online. And one of the ways of making money online is investing in the stock market. And that is why I'm making this video, to expatiate on investing and making money in the stock market. I also have courses on Skillshare and Udemy. If you want to find out more about that, you can check the link in the description box of this video. That gives you a good idea of who I am. I like making money and I like seeing other people make money too. So I try my best to not just make the money alone, but tell other people the different ways of making money. And today, our way of making money is through the stock market. Yes, stock market. You've heard of stock, you've heard of shares, you've heard of all this terminology. What is actually a stock? A stock represents equity ownership in a company. Now, before we go to stock, let's even talk about share. What is a share? Now, you are seeing the picture of a pizza. A share, as the name implies, is just a part of something bigger. A share of it. When the hand is taking a piece of the pizza, that's what we call it, a share of the pizza. But in our own case, we're talking about a share of a company. So the analogy is the same. You're taking a part ownership in a company. Now, all the shares, the total collection of the shares is called stock. So if you pick one, it's called a share. But 100%, which is everything, is what we call stock. And it is equity ownership in a company. Equity ownership in a company simply means you are the owner of the company. If you buy a share from Amazon, it means you own a part of Amazon. If you buy LinkedIn share, Facebook, Google, whatever company that you buy a share, it means you are part owner of the company. The way you pick a part of a pizza to eat, so it means you are part owner of the company, which means that people that work in the company are technically working for you. So if you buy a share in Amazon, people that work in Amazon are actually working for you because the profit comes to you. You are the owner. Well done, boss. So you see why it is very interesting, because you will just be in your house and be a part owner of a multinational company like Amazon, Google, Facebook, just at the comfort of your house when you buy a share. Now, someone that buys a share is called a stockholder or a shareholder. It means you own a share, you are holding a share. Since you own a share, the profit, the asset of the company, you own it. What you own is proportional to how much you invest. So if you buy 2% of the shares, it means that you only own 2% of the company. If you buy 50% of the share, it means you own 50% of the company. If you buy 0.00001%, it means that's what you own. Why are we talking about buying share, owning a company? It's because history has shown us that the stock market is profitable. A lot of people are making money through the stock market. And I told you that I make videos on how to make money online. And I can tell you that the stock market is one of the easiest and best ways to make money in our current world. There are other ways of making money, but history has shown us that the stock market is one of the easiest and fastest ways of making money. It has outperformed other investments. Just to conclude this slide, there are other ways that we can buy shares and stocks, but most of the times we buy it from the stock exchange. There are two types of companies in our modern world. It's either the company is private or it's public. If it's private, it means it's owned by individuals or organizations. And if it's public, it means that it's owned by public, or the public can buy it. It means the average man on the street, the normal man on the street, can be a part owner of the company. The process whereby a private company becomes a public company is what they call initial public offering. So they say they are doing an IPO. It means they are turning from private ownership into public ownership. If I start my own business today, the business belongs to me. You cannot come tomorrow and say, that you own the business. No, it's my business. If I go for IPO, which means I make it public, it means you can buy shares and become part owner of the business. So IPO is just the first time that a company is becoming public. Before you become a public company, there are some requirements that you must meet. And what is very common is the unicorn status. Unicorn status simply means that you have to be worth about $1 billion. Most public companies are more than $1 billion because there are some requirements you have to meet before you can become a public company, which means the public, anybody can buy shares in your company. Anybody can invest into the company. Why do companies do IPO? Like, why will you want to become a public company? Why not remain private? Why do companies go for IPOs? The major reason is to raise capital. When you start a business, if you need money, what do? You call your family members, you call your friends to help you. They're starting a business and they support you. Good. There's a limit to what I can give you. If you need more money, you know that it may be beyond what your family, what you can call your family to give to you at that point. Then someone will be like, go to bank and get the money. Of course, when you go to bank, it comes with an interest. Bank doesn't just give you money without an interest. And sometimes the interest can be significant because they are not so sure that you actually pay the money back. What if you need a significant amount of money? Let's say like $5 billion, $20 billion, even $1 trillion. Do you think the bank has that money? And if they choose to give you that kind of money, the interest that they will levy on you, goodness, it won't be worth it. Because if they give you huge amount of money, the interest that you pay on that money will be so much that even you will not be interested in taking the loan. When big companies need more money in order to invest, diversify, in order to keep growing, as a company, you want to keep growing, and you need more money to grow. So instead of going to the bank where they will charge you high interest and they may not give you up to what you want, you do an IPO. So this IPO simply means you become public. It means you are selling now to the public. It's a way of saying the public should bring their money and buy your company. Because they are buying into the company, they are giving you the money, which means you are not paying them interest. So you see the huge difference. When you borrow from a bank, you pay interest and sometimes it's significant. But when you do an IPO, you are not paying interest to any bank. Instead, people that buy shares in your company become part owner with you, that's the owner of the company. So the main purpose why companies do IPO is to raise capital for expansion. You want to keep increasing. You are in the US, but you want to go to the UK, Canada, Germany, France, and you need more money. So IPO gives you the money. Another reason why companies do IPO is to give liquidity for the founders or the private investors. Now, Jeff Bezos, that's the founder of Amazon, when he started the company, he owns the company. He owns all the shares, all the stakes in the company. When you own a company, does not mean that you own money. You can own a company without having money in your account. But if you sell the company or sell part of the company, you can have money. Because when people buy part of it, they give you money for it. So companies do IPO so that the founders can have money. You can see, that's why they're happy. They are the founders of the company and they have been working hard over the years. So IPO give them the opportunity to be happy, to celebrate, because now they can sell the company or sell part of the company and get real money to compensate them for their effort. Private investors are people that have invested with the company when it was starting up. So IPO give them the opportunity to get something back. Another reason why companies do IPO is to have a higher value. A company may be worth $1 billion at the time of IPO. Once they have gone public, we think that, it should have more value. So as people start buying shares on it, the price will keep increasing, which means the worth of the company is increasing. So that's another reason why companies do IPO. They want to have higher value than what they currently have. Another reason why companies do IPO is for publicity. They want to create huge publicity for the business. IPO is very popular. It's all over the news. You hear it. Deliveroo is about to do an IPO. This company is about to do an IPO. They make news, they make noise because it's a big deal for big companies. So they want to create publicity for their brand. So that's one of the reasons why they do an IPO. Amazon is doing a lot of things because you and I bought shares in Amazon. So they use the money to build new warehouse, to open stores, to start Amazon Prime, to buy Twitch. They use the money to keep growing, and growing. Now that you know what an IPO is, what is stock market? Before we go to the stock market, let's look at the broader theme, which is financial market. Finance, another word for money. The financial market is a market where the trading of securities occurs. There's buying and selling of securities. Security simply means shares, bonds, or shares and bonds. It also includes other financial instruments related to shares and bonds that I will discuss in the later part of this video. The word trading simply means to buy and sell. The way you go to market or go to a shop to buy and sell, or the way you order something online, you are trading. Because once you pay your money, they will send you a camera that you've ordered. Once you pay your money, they will send you the laptop or the iPhone that you've ordered. The stock market is just a part of the financial market. It's the market that involves the buying and selling of stocks. Another word for stock market is share market or equity market. So when you buy a share, you are buying a stock or you are buying an equity. They are synonyms. So how does this stock market work? Now we've talked about IPOs, where companies become public. So in the course of becoming public, they create securities, they create shares that you and I can buy. When companies go public the first time, it's big companies that actually buy shares. Remember I told you that most companies want to reach the unicorn status of $1 billion before going for IPO. So people that mostly buy shares at that first time are big companies that have a lot of money to pay at once, like Vanguard, insurance firm, banks. They are usually the ones that can buy a company at the early stage because they have a lot of money to drop at once. You and I may not have a lot of money to pay at once. We're talking of billions of dollars to just drop at once. Once they have bought the securities, you and I can buy it from them. So they want to sell it. They're like the wholesaler now. They want to sell it now to you and I. So you and I now are called retail investors. We are the one now that buy from the big boys. The big boys are the big companies. Give an example like Vanguard, HSBC, JP Morgan, Morgan Stanley. You know the big boys. And once they have bought the company now, they can sell it to you and I at the price that we can buy. We are the secondary market because we are the one that are experiencing the subsequent trading. The first time is the initial trading. So any other trading, any other buying and selling after this IPO, subsequent trading, and it's called the secondary market. So if I go and buy share now, I am buying it in the secondary market because the primary market has been done and forgotten. This secondary market, because it's what you and I experience, is what we know is more popular. We call it the stock market. Some people call it the stock exchange, but it's not actually the stock exchange. The next slide, I will explain the stock exchange. By watching my video, you know better than a common man that the stock market actually includes both the primary market and the secondary market. It includes everything. Even on the news, whenever they say stock market is down, they're not talking about the primary market, they're talking about this secondary market. Some people even call it stock exchange, but it's not a stock exchange. You will know why some people call it stock exchange. Now, what is stock exchange? A stock exchange is a market in which securities are bought and sold. I told you that when we talk of securities, we are referring to shares, bond, or it could be a hybrid of shares and bond, or derivatives. Derivatives are financial instruments that derive their value from the underlying asset, which could be a share or a bond. I want to give you an example of how the stock exchange works. Now let's assume that we want to buy share from Amazon. Let's assume there's a buyer, B. B is a buyer. This buyer, B, wants to buy Amazon shares. So we have Amazon shares, A. So B wants to acquire Amazon shares. You cannot just walk into Amazon office and tell Amazon you want to buy their shares. No, there have to be a meeting point. So that meeting point is what we call stock exchange. Let's use a different color for it. So the meeting point where the buyer of shares can come and the seller of shares can meet in order for them to be a transfer of shares is called the stock exchange. So this is the meeting point. The buyer will come here and meet. Now this is the seller. The seller will come here and meet. So this meeting point or the location, the venue where the buyer and seller of shares meet to perform trading transaction is called the stock exchange. I've explained that the main purpose of the stock exchange is to serve as a medium or a location where there's exchange of securities, where there's trading of securities. Now, the stock exchange also perform other duties like liquidity. Liquidity is simply the easiness of an asset to be bought and sold. I want to avoid the scenario when I want to buy a share and they will say the share is not available. So the stock exchange ensure that Amazon share is always available for me to buy when I want to buy. So it ensures that there's liquidity, not just for the buyer, but for the seller. That if someone wants to sell Amazon shares, that there's always market for the person to sell Amazon shares. And it will be easy to buy or to sell. This duty is ensured by the stock exchange. Also, the stock exchange ensure orderliness. It's as simple as order. It helps to ensure that things are done in an orderly manner, in a proper manner. A is not tricking B, or B is not defrauding C. So that things are done the way they should be done. Equally, the stock exchange ensure that there is fairness, that the market is fair, that when someone buys shares and another person sells shares, the price is updated for other people to know the last price. That things are fairly done so that nobody will complain of being cheated in the market. The stock exchange also ensures safety. The stock exchange ensures safety of the transaction, that if I sell my shares, the money will actually come to me. And also, if I buy shares, the share will be delivered to me. And finally, the stock exchange ensures transparency. Everything is open. Everything is well regulated. It's not a hide and seek game. Everything is visible for all to see. The duty of the stock exchange is to ensure that there's liquidity, orderliness, fairness, transparency, and safety of trading of securities. A good example of a stock exchange is the New York Stock Exchange. Now, this building you are seeing is the New York Stock Exchange in 2008. So that shows you how the stock exchange look like. It's a venue, it's a location where there is trading of securities. We also have the NASDAQ. We have the London Stock Exchange. Those of us from the UK, I greet you. Your stock exchange is here. Now, this is the National Stock Exchange of India. So, our Indian subscribers, thank you. NSE also represents Nigerian Stock Exchange. I am from Nigeria, so my fellow Nigerian people, well done. Oh. We have the Toronto Stock Exchange for our followers and viewers in Canada. Tokyo Stock Exchange. If you're from Tokyo, raise your hand. Moving forward, we have the Shanghai Stock Exchange. Our Chinese people, we greet you. Then we also have Euronext. This is the stock exchange for European Union. So if you're from France, Germany, Netherlands, and other European countries, I send my regards. There are more and more stock exchanges. I can't include all of them in this video. So if I didn't mention the stock exchange in your country, just go on Google and type stock exchange in your country and tell me your country and the stock exchange in your country. What are the categories of stock exchange? We have three types of stock exchange. We have the auction stock exchange. This is known as the open outcry system. A good example is the New York Stock Exchange. It involves the open outcry system where there is buying and selling of securities. They are shouting, buy, sell, buy, sell, buy, oh, sell, oh, buy, oh, sell. Oh. There's noise. They are bidding for price for customers. You hear them loud and clear. Buy, sell, buy, sell. So that's the auction stock exchange. They use the auction method of trading. Now, due to the advent of technology, you agree with me that not everybody wants to go to a physical location and be shouting buy and sell. So because of that, we have the electronic stock exchange. All these platforms that I've mentioned, apart from the New York Stock Exchange, are all electronic stock exchange. So here, if I'm to cover it, we have all these ones are electronic stock exchange, which means there's no physical location for the stock exchange. Everything is done online. We're in the modern world. An advanced form of that is the digital stock exchange. For the digital stock exchange, we are talking of cryptocurrency. These are on a different whole level. They're mostly used for cryptocurrencies like Bitcoin, Ethereum, XRP, Bitcoin Cash, the rest. So all of them are transacted with the digital stock exchange. And a good example is Binance, which is the biggest digital stock exchange in the world. We also have Coinbase, for those of us in America, is the largest stock exchange in US. In California, we have Kraken. To conclude this slide, we'll talk about the difference between stock exchange and over-the-counter. Now, I've told you about the stock exchange. For a company to be listed on the stock exchange, the company must have done IPO that I've explained earlier and have met some requirements, such as the unicorn status. You agree with me that not every company can meet the requirement. So for companies that cannot meet the requirement or has been delisted from the stock exchange, they trade their shares over the counter. So over the counter is a process that involves the trading of securities through a broker-dealer network. And it is mostly used for securities that have not been able to meet the requirement of the stock exchange or were delisted from the stock exchange. Also, some securities that are listed on the stock exchange are sometimes traded on over-the-counter. So who actually are the market participants on a day-to-day basis? Now we have the retail investors. The retail investors, as the word implies, are investors and traders that buy in small quantities. So if you and I want to buy shares now, we are not buying like $1 billion shares. We are buying in small quantity, $100, $1,000, $5,000, $300,000, and we are buying in small quantities. So the retail investors are referring to you and I that buy and sell shares in small quantities. We have either a personal account or a professional account. Now, the opposite of the retail investors is the institutional investors. These refer to big companies that buy shares in large quantities. A good example is Morgan Stanley, JP Morgan, HSBC, pension funds, insurance firms that have a lot of money to buy shares in large quantity. When they buy shares, the market feel their impact. As I take you through this video, I'll tell you more about the difference between investors and traders. The next participant is a broker or a brokerage firm. I would like to explain with an example. I told you that we have a buyer and he wants to buy Amazon shares. I want to buy shares from Amazon. And you can remember in the previous diagram I drew before, which I'm repeating now, the meeting point is the stock exchange. The stock exchange is where there is buying and selling of shares. Actually, I cannot walk into the stock exchange to buy shares because remember, I'm a retail investor. I am buying in small quantities. We said that the green is the stock exchange. The stock exchange only deal with people that have registered with them. So if you have not registered with the stock exchange, you cannot just come and be dealing on shares. There are companies that are registered with the stock exchange. Here, so this blue have registered with the stock exchange. They can deal with the stock exchange. Because I'm not registered with the stock exchange, I can buy the share from the broker. This blue is the broker. So I will go to the broker to buy the share. Then the broker will buy the share from the stock exchange. So this blue now that serves as the intermediary between the buyer of shares and the stock exchange is what we call a broker. And if it's a firm, it becomes a brokerage firm. It serves as an intermediary between the stock exchange and the buyers or sellers of shares. And the brokerage firm mostly work with the retail investors. So if you and I want to buy shares, we're not walking straight into the stock exchange. We are meeting the brokerage firm to transact the buying and selling of shares. Pay them commission so that they will go and buy the shares for you on the stock exchange. Of course, everything is done electronically, so it's happened very fast. Now, the next participant in the market we have is the market maker or specialist. In New York Stock Exchange, it's called a specialist, but in other stock exchange, it's called a market maker. Now, a market maker works for the stock exchange in order for trading of securities to happen. I told you that the stock exchange buy from the seller and sell to the buyer. So is the middleman, is either he is buying or is selling. Perform both duties. If you are buying shares, the market maker has shares to sell to you. And if you want to sell, is ready to buy from you at the given price so that the market will be continuous. It ensures that there's liquidity in the market. So when you're actually buying shares, you are not necessarily buying it from another individual. You are buying it from the market maker. And when you are selling to the market maker through your brokerage firm. Why are we studying all these things? What is the purpose of all these things that we are learning? It's because we want to invest. That brings us to the question, what is investing? Investing involves committing money in order to earn a financial return. So you are putting that money in order to earn a return. Now, what is a return? A return is the benefit you get from investing. So it's like the profit or the gain that you get. We invest in order to get a return. Risk is the possibility of something bad happening, which means that things may not go the way you plan. You plan to get $100 back, but you get nothing. Let's use the example of the diagram. He's dropping a coin. So let's assume that he's dropping $100 in order to reap $1,000. So investing is the process of dropping this money in order to reap this amount. I deposited $100 and I'm getting a profit of $900. This profit of $900 that I'm getting is what we call return. Is the gain, is the reward for investing. Now risk is the possibility that I may not get $900. Instead of $900, I may get $90. Instead of $90, I may get $0. So risk is the possibility of something bad happening, that I may not get my intended return. And in investing, risk and return are proportional. It means the higher the risk, the higher the return, and the lower the risk, the lower the return. If your risk is very high, it means your return should be high. And if your risk is low, it means your return should be low. Now, when we talk of investing, we're always thinking of money, money, money. But there are different kinds of investing. And a good example is you watching this video. By you watching this video, you are investing. You will ask, what am I investing? You are investing your time. And by investing your time, you are getting a return. The return is knowledge. You know now about investing. You know now about the terms used in the stock market. You are better now than an average man on the street. You have more knowledge about the stock market. You are investing. Just by watching this video, you are already investing. There are different kinds of investment you can also make. Some people spend time with their spouse in order to have a good marriage. So you are investing your time, your commitment, your passion and emotion in order to reap a successful marriage. You go to school to get a certificate. The certificate is the return. So there are different kinds of investing that you can do. Don't just think it has to be in terms of money. It can also be you starting a business in order to be successful. It can also be planting trees in order to reap a forest. For the purpose of this video, we are interested in financial investing, how we invest like this and reap more. So that's our interest. We want to invest and reap much more than we deposited. The question we have is, why should we invest? What is the purpose or the aim of investing? There are two ways of making money. It's either you work to get paid or you invest to make money. There are the two major ways of making money. When you invest, you are looking for your asset to increase in value over time. A good example is real estate. When people buy a house, in order to sell the house at a higher price. So that's a good example of investing. You want your asset to increase over time. And the great thing about investing is that it's passive income. Once you invest your money, you forget about it till the time that you want to sell, then you go and sell it at a higher price, hopefully. So it's passive income. It's a classic example of passive income because you are doing nothing. You just buy, and when the price has increased, you sell it. Another reason why people invest is to enjoy the benefit of compound interest. Compound interest simply means you are getting interest upon your interest. You're not only getting money from your principal, you are getting interest upon interest upon interest upon interest upon interest. Somebody should add the background music. It simply means your gains are reinvested automatically. Albert Einstein, one of the most intelligent people in the world that ever lived, says that compounding is the eighth wonder of the world. I will show you an example. Let's look at this chart that I obtained from Web Simple. If you have $20,000 and you want to keep it for 30 years, there are three options that you have. You can choose to keep the money under the mattress, and after 30 years, the $20,000 will still be there under the mattress, hopefully. But what would have happened is that the value would have decreased due to inflation. Inflation does not mean that the $20,000 will not be there, but what you can buy with the $20,000 would have reduced in 30 years' time. So because keeping your money under the mattress reduces the value of the money, a lot of people go for the saving option. And if you are lucky and your bank offers 2% interest rate, you are one of the most lucky people in the world. After 30 years, remember I'm talking about 30 years, your money would have grown from 20,000 to 36,000. So this is what you get after 30 years when you deposit your money in a bank that has a 2% interest rate for 30 years. Why invest? So if you invest in the stock market and you get the average return, 5.5% is an average return in the stock market. Some people get higher than that, some people get lower than that. So we just pick an average, which is 5.5%. If you invest the money, $20,000, for the same period of time of 30 years, your $20,000 would have increased to $99,000. That's almost $100,000. So you see that $20,000 is the same thing for the three cases, but one is giving more money than the others. And remember, in this three scenario, you are doing nothing. You just keep your money and forget about it. So in 30 years' time, you come and check back what has happened to the money that I kept. So you see the difference from $20,000 to $99,000. That's huge for doing nothing. This is the reason why we talk about investing, why you should invest. Remember, this is an average. So imagine your own investment is twice of this. So you'll be getting about $200,000. Some people have triple of this. This is the reason why I am making this video for you, as a way of making money online. Remember, this channel is all about making money online while you are at the comfort of your couch. Before we go further, do me a favor by smashing the like button, smashing the subscribe button, smashing the share button, so that YouTube will recommend this video for other people to watch it. This video can go viral, and it takes you to make it go viral. Just by you liking this video, it becomes a viral video. I put a lot of effort into this video. Please support this content and make it go viral by you just liking this video. If you are watching on a TV, it doesn't stop you from going to your phone and hitting the like button. Thank you for doing that. Let's give an example of compound interest. Why Albert Einstein says is the eighth wonder of the world. Now, if you deposit $5,000 in a bank that has a 3% interest rate per month, and you're putting the money in the bank for 15 years. So we're looking at two scenarios, the case of simple interest and the case of compound interest. So if they are paying you the money based on simple interest, at the end of 15 years, you will get $32,000. But if it's compound interest, for the same time period of 15 years, you are getting about $1.02 million. Imagine the difference between $32,000 and $1.02 million. You see why compound interest is the eighth wonder of the world? Because it has the potential to increase your money from $5,000 to what? $1.02 million in just 15 years. And in the stock market, you can even get more than this. So you see why I'm making this video? Because you can actually earn a lot of money through the stock market. Before we go further, let's look at the difference between investing and trading. A lot of people confuse trading with investing and investing with trading. What actually is investing And how is it different from trading? When we talk of investing, we are talking of you buying, holding, and selling. So investing involves buying assets like shares. You hold it for a period of time before you sell. But for trading, you buy and sell. There's no holding period. The investor believes that you can build wealth over a long period of time. So you buy and hold it for like 10 years, 15 years, 20 years for the price to increase before you sell. But the trader wants to make money as early as possible. I want to make the money today. As I'm making this video, I want to make the money. The trader believes in making money in small increments in order to build wealth. Two of them want to build wealth, but one believes in a longer time horizon, which is the investor, unlike the trader. In summary, we're saying that the investor is looking at the longer term outlook. He's interested in what will happen in 5 years' time, 10 years' time, 20 years' time, 100 years' time. Whereas the trader is interested in short to medium outlook. What will happen in 2 seconds, 5 seconds, 1 day, 2 weeks? You can now see the difference between an investor and a trader. The investor wants to make profit from compound interest. As the price increases, investor wants to make profit once the price increases. But the trader does not have the patience for the price to increase before making money. He wants to make money through price fluctuation, which means whether the price is going up or is coming down, the trader wants to make profit. We have 2 types of investing: passive investing and active investing. Passive investing mostly refers to ETF investing, where you deposit your money and just forget about it till you need the money and go and sell your shares, your stock, or your ETF. Whereas active investing is what's commonly done using mutual fund, where there's a day-to-day decision on investing. Let's give an example that 2 of them are interested in investing for 10 years. So the passive investing will just put the money, okay, maybe after 5 years, look at the money, okay, is it still there? After 10 years, sell the stocks and get the money. But the active investing involves you are investing, but you are more aware, you are more conscious what's happening on a day-to-day with my shares. Has it gone up? Has it come down? What's happening? What decision is being made in the market? Should I buy more or I should reduce my asset? Is active, as the name implies. Now, for trading, we have different types of trading. We have the scalp trading, scalpers. So the scalp trading involves trading within seconds. So this involves seconds to minutes decision. So within seconds to minutes, you are making decision whether to buy or to sell. Now, day trading involve trading within a single day. You don't allow your trading to cross over to the next day. You want to make the whole decision in 1 day. You buy or you sell in 1 day. Swing trading is the type of trading that's involved between days and weeks. So for swing trading, you are looking at days to weeks, 2 days, 7 days, 2 weeks, 3 weeks. And position trading involves trading between months and years. So you're talking of 6 months, 8 months, 2 years, 7 years, 30 years. It's in bold because it's almost similar to investing in the sense that it can be long term, it can be 100 years, it can be 50 years. But you are still a trader because you are interested in making profit through price fluctuation instead of the overall price trend. For an investor, you are mostly interested in fundamental analysis. So before you buy, your interest is fundamental analysis. In session 3 of this video, we'll dwell with fundamental analysis. But the trader is mostly interested in technical analysis. Finally, the investor is interested in long positions, and the trader is interested in both long and short positions. So what is a long position and what is a short position? Now you've heard of someone saying, I'm going long on this stock, or another person saying, I'm going short. It doesn't mean long journey. If you're going long, you want to buy when the price is low and sell when the price is high. So you are someone that want to buy before you sell in order to make profit, of course, which is the reason why you're waiting for the price to increase. When you're going long, you are going like this. It's an upward trend. But when you're going short, it's a downward trend. You are going down. So when you're going short, you are starting from selling. You are selling when the price is high, and you are buying when the price is low. When the price is high, you sell. So that when the price decreases, you go and buy it back. The question that people ask is, if you are to start from selling, how do you get what you sell since you did not buy it? That's where this option comes. You can borrow shares from a broker in order to sell it, so that when the price has decreased, you can buy it back and return it to the broker. If we are to give an example, someone that's buying low is buying at $10 and is selling at $100. So the profit is $90. Now, someone that's selling high is selling it high at $100, and he or she will go and buy it back when the price has decreased to $10 and makes a profit of $90. And I told you that for you to sell it, you have to borrow it from a broker. It's allowed to borrow shares as a trader, but you can't borrow shares as an investor. So this is one of the significant difference between an investor and a trader. Remember, here we have the investor and here we have the trader looking for how to make money from the market. The good thing about being a trader is also you can go short, which is this. You can also go long. So a trader, if I'm to use a different marker, I would say that an investor is restricted to only going long. Can only go long as an investor, but a trader can go long and can go short. So a trader can go both ways, but an investor only go through one way. So now that you know that a trader can go in both ways, do you think that being a trader is better? Tell me in the comment section of this video. Just to add to investing and trading, one of the most popular thing you hear in the market is bull or bear. The bull is the buyer. So when the bull is fighting, you can see the horn is fighting upward. So it's someone that believes that the price will rise. So he buys and believes that the price will rise before selling. Whereas the bear is the opposite. Bear, when it's fighting, you can see that the legs are down. So he is someone that believes that the price will drop. He will short sell his position. You can make money through both methods, but an investor goes through the bull method of buying to sell later, whereas a trader can be both, as I've explained to you in the last slide. If this is the price of a share over time, now you can see that the price is rising here, and the reason why the price is rising is because there's more demand than supply. So when there's more demand than supply, the price will rise. And when there's more supply than demand, the price will drop. It's just like every other thing that we deal with on a day-to-day basis. If there's competition for something, everybody wants to get it, the price will rise, like an iPhone. But if there's no competition, nobody cares about it, the price will decrease. So the same thing happens for stock. What if the demand and supply are equal, which is the scenario we have here? So you see the price will be stable when the demand and supply are equal or almost equal. We'll be talking a lot about shares, buying, selling. So let's go and deal with a real life example using Apple shares. Apple shares. So the price of a share of Apple is $129. As of the time I'm making this video, you see it here. Now this is performance for 1 day, for 5 days, 1 month. So let's check the maximum performance. Apple shares has moved in an upward direction. So there was a time that it was selling for $0.12, which means that if you had bought the Apple share in April 1981 for $0.12, today, which is 2021, you'll be selling the same share for $129. So imagine the profit that's there. That's about $129 just for one share. And if you have bought 1,000 shares, it would have become about $129,000. So you see how you can be so profitable with the stock market. And you don't have to do anything. Just buy it and hold it till the price have increased to what you want. Then you can sell. So this is a good example of making money from the stock market. So we can see the price. What you're seeing here that's going up and down is the price. The price performance for each day, for each month, for each year. You can see it down. You can change it to year, to month, and to weeks, depending on what you want. So, but this is the price movement. It also shows us the past performance or the history of Apple shares. That there was a time it was down and started rising, started rising, started rising. So that's the past performance. So we will say that Apple shares has performed well in the past. But in investing, they will always tell you that past performance is not the best predictor of future performance. Also, we have the volume, which is the demand and supply. So this price is going up and down because of what? Demand and supply. That I've explained to you in the previous slide, that when there's more demand, the price will rise. And when there's more supply, the price will drop. So it means over the years, Apple shares has been in more demand. The last part is volatility or dispersion. Volatility or dispersion is just this up and down movement that you are seeing over the mean. So let's give an example. Let's pick a pen. If we're interested in Apple shares for this period from 2014 to like 2018, now you see, if we take an average of the price, it should be somewhere like here. So that should be like the average price of Apple shares, about $30 to $35. This increment in price and the decrease, it goes up, it comes down, it goes up again, is what we call volatility. Is the dispersion, is the spread across the mean, a central mean position. It has a mathematical formula for calculating it, but it's beyond the scope of this video for now. That's to tell you about the terminologies that's used in stocks and shares. This beginning is the period when it has done IPO. For it to be listed on the stock market, it must have done IPO here. IPO. For it to be listed on the stock market. So, and then people start trading on it, investing, for it to go up and down. Now, we've talked about a good example. Let's look at example where people can lose money through investing, using the case study of Blackberry. Here, I discovered I can make profit by investing in Apple. You can also have made loss if you have invested in Blackberry. So just like the way we search for Apple shares, you can type Blackberry share. So you can see this is the performance for one day. We'll go to the maximum performance. You see, it started low, then it moved up and came down. Now it's selling about $9.08, which is the current price here. If you have bought Blackberry shares at the beginning here and you sold it here, you would have made a profit. But if you bought it in 2008 when the price was high, in 2021, as of today, you would have made a loss if you're investing. In as much as you can make a lot of money by investing in the stock market, you can also lose money by investing in the stock market. In subsequent sessions, I will show you how you can invest in the stock market so that you gain money instead of losing money. Now let's review what you've been learning. We started talking about stock. The stock is equity ownership in a company. It means 100% of shares. And a share is just a unit of a stock. So 1 out of 100. So we're saying that stock is 100% of shares. And a share is just 1%. Or 1 out of what? 100. Now, we want further to talk about the stock market, where we discuss that the stock market is the market of everything that happens with stocks. The stock market is the market where there is trading of stocks. The buyers, the sellers, the exchange, the retail investors, the institutional investors, everything is under the stock market. If you remember in secondary school, I talked about the Venn diagram. So if this is the Venn diagram, we say this is the stock market. Stock market. So it has retail investors, it has people that's buying, it has the seller, it has institutional investors, it has everything that has to do with stocks. All of them fall under the stock market. Now, moving further, I will talk about the stock exchange. That the stock exchange is an exchange, it's a location, it's a venue where there is buying and selling of shares. So here is the buyer and here is the seller. They meet here. We said that the meeting point, which is green, this meeting point of the buyer and the seller is the stock exchange. So that's where there is trading of securities. It can be auction in the case of New York Stock Exchange, which is a physical location. It can also be online in the case of Tokyo Stock Exchange, Toronto Stock Exchange, Nigeria Stock Exchange, and several other stock exchange. And it can be digital in the case of cryptocurrency like Coinbase, Binance, Kraken. Now, to go further, we'll talk about investing, where we'll look at what is investing. That investing involves committing your money to earn a financial return, to earn more money. So we'll give an example that you putting down like $10 in order for you to gain $1,000. So that's a classic example of investing. You are putting that money to earn more money. And we conclude that the reason why people invest is because it's passive income. You invest your money and forget about it till you need the money, and hopefully the price is up. You can sell it and make money. And we also said that when you invest, you enjoy the benefit of compound interest. That the process whereby these $10 become $100 is through compound interest. Because it won't just move from $10 to $1,000. It will go from 10 to like 100 to like 700 to like 800 before you get to 1,000. Then, because you're leaving your money in the stock market, the interest is being added to your principal. The interest is being added. You keep making interest upon your interest. So it's what we call compound interest. Yes, we talk a lot about compound interest. That is the major reason why people invest. In order for your money to keep accumulating. And that's how the rich actually become rich. They use money to make money, if you have heard about that. So that's a classic example of compound interest. Now, we also talk about investing versus trading. The difference between investing and trading. And we said that the major difference is that an investor is concerned with longer term outlook, like 5 years, 10 years, 20 years, even 100 years. But a trader is interested in the short term outlook, 2 seconds, 5 seconds, 1 day, 2 weeks, can also be 1 year. So, and we want to say also that an investor is interested in the long positions. So an investor buy in order to sell and make more money. But a trader is interested in both long and short position. So if the price will go up, the trader will buy and sell. If the price will come down, the trader will sell and buy back later. And we look at the real life example of Apple shares and Blackberry, where we said that Apple shares is a classic example of making money through shares, and Blackberry is an example where someone could have lost money investing in the stock market. And I told you that this is just the first session of this video, that in subsequent sessions of this video, I will show you how you can really invest in order to actually make money and not lose money. Yes, thank you for watching this video to this point. This is the end of the first session. Thank you, 5-star for you, for being so patient, for taking that note, and for subscribing to my channel. Thank you for subscribing. Thank you for liking this video. Thank you for sharing this video to your friends, to your loved ones. They're like, the stock market is a bit confusing. What is actually happening? This video is very detailed, step by step, explaining the stock market for a complete beginner. I'm assuming you don't know anything about the stock market, so I'm explaining it detail by detail. So if you not share to your family members or to your friends or to your classmates, you are not helping them. So please share this video. And I told you that you can make this video go viral by liking this video. So please encourage my channel, encourage this content by liking this video. Thank you so much. Thank you so much for doing it. And The last, not the least, is an assignment. At the end of each session, I'll give you an assignment, which I expect the answer in the comment section of the video. So what's the assignment? We'll talk about investing. We'll talk about trading. Do you think that investing is better than trading, or trading is better than investing? There's no right or wrong answer. Just give 2 reasons why you think that investing is better or trading is better. The second part of this video will be playing here. Click on it and let's continue.